we are not isolated from the rest of the world. I've been saying it's going to be very confusing, very confusing. And this is just one indication, the worst mistake they had made in their lives. Prices started going crazy. We had the oil embargo, quadrupling of oil prices. Most economic indicators were in nominal terms. They didn't break out real from price or real from inflation.
Don't forget to subscribe, crypto traders. Let's continue with the interview and the analysis of this one.
Perhaps the debt load associated with 20 years of buy-the-dip property transactions in China reached an untenable point. Many statistics out of China are negative. And Europe, by some measures, is in recession. So maybe these multinationals are suffering more because of what's going on in the rest of the world. But I do think we are not isolated from the rest of the world. So again, lots of confusion. And anyone who's been listening to In the Know for a while knows that I've been saying it's going to be very confusing, very confusing. And this is just one indication. When I first started in the business in the late 70s, I was in college, I heard portfolio managers back then talking about the worst mistake they had made in their lives, their professional lives. In the early 70s, after we went off the gold exchange standard and all hell broke loose, prices started going crazy. We had the oil embargo, quadrupling of oil prices. Most economic indicators were in nominal terms. They didn't break out real from price or real from inflation. And because of that, they looked at earnings exploding, and they could not understand why the market was going down, and they kept buying the dip, buying the dip. It was a big mistake because what was happening back then.
China's property market has long been a central pillar of the nation's economic growth, but recent developments suggest storm clouds gathering on the horizon. Over 2 decades of robust property transactions have led to an alarming escalation in debt levels, prompting concerns about sustainability and ripple effects across various sectors, including multinational corporations. The gravity of the situation becomes evident when examining the negative indicators emanating from China's real estate arena. The data paints a grim picture, signaling a looming liquidity crunch that threatens the stability of the property sector and extends its reach far beyond national borders. At the forefront of this crisis stands Evergrande, China's largest and most indebted property developer. With liabilities exceeding a staggering $300 billion, Evergrande's financial quagmire reverberates throughout the industry, affecting creditors, suppliers, and even home buyers. The scale of its indebtedness underscores the systemic risks embedded within China's property market, sending shockwaves throughout the global financial landscape. For multinational corporations with interests intertwined with China's economic fortunes, the implications of the property debt crisis are profound. Uncertainty looms large as companies grapple with the specter of disrupted supply chains, dwindling consumer demand, and heightened financial volatility. The ramifications extend beyond immediate financial losses, casting a shadow over long-term investment strategies and market outlooks.
Inflation was the only reason earnings were going up, and the market doesn't pay for earnings caused by inflation. And so that's when we started separating inflation from real growth, and we've been there ever since.
Understanding the distinction between nominal GDP and real GDP is pivotal in grasping the true economic landscape of a nation. Here's a breakdown of these concepts in a coherent and practical manner. Nominal GDP reflects the market value of all final goods and services produced within a country's borders during a specified period, computed at current market prices. It encapsulates the raw monetary value generated by economic activity, unadjusted for factors such as inflation or changes in purchasing power. Conversely, real GDP offers a more nuanced perspective by accounting for fluctuations in the general price level, thereby providing a more accurate measure of actual economic output and growth. Real GDP calculations involve adjusting nominal GDP figures to reflect changes in purchasing power, thus filtering out the distorting effects of inflation. Inflation stands as a key determinant behind the growth of nominal GDP. However, it's crucial to recognize that markets do not reward earnings driven solely by inflation. Real economic growth, represented by changes in real GDP, signifies genuine increases in production and productivity, stripped of the confounding influence of price movements.
Today, we might be on the opposite side of that problem. Now, most portfolio managers, as they're gauging the health of the economy, they look at real GDP. And inflation is just a separate metric that they know the market doesn't pay for. So, well, that's okay until you run into negative money growth negative revenue growth caused by falling prices, companies losing pricing power, and unit volumes not being that strong.
Inflation and deflation are two economic phenomena that significantly impact the economy, altering the purchasing power of money and reshaping various aspects of financial life. Inflation embodies a general increase in prices over time. This surge undermines the value of money, effectively reducing its purchasing power. Various factors contribute to inflationary pressures, ranging from excessive demand in the market to sudden shocks in the supply chain. Additionally, the growth of the money supply and the mere expectations of future price hikes can also fuel inflationary trends. The repercussions of inflation extend across multiple dimensions of economic life. Income distribution undergoes shifts as the real value of wages and salaries fluctuates in response to rising prices. Moreover, relative prices among goods and services undergo alterations, influencing consumer behavior and market dynamics. Additionally, inflation affects saving and investment patterns, compelling individuals and businesses to reassess their financial strategies in light of changing economic conditions. Conversely, deflation presents its own set of challenges. Characterized by a general decline in prices, deflation amplifies the purchasing power of money. However, prolonged periods of deflation can disrupt economic stability, potentially leading to reduced consumer spending and investment. As prices continue to fall, consumers may delay purchases in anticipation of even lower prices, exacerbating economic downturns and impeding recovery efforts.